Welcome to The Mortgage Voice with Jeff Barton, your voice in the mortgage industry. Each week on this program, Jeff and his guests share their expertise, personal anecdotes, and the latest industry news to keep you in the loop. Now, to provide you with insight and help you navigate the consistently changing world of real estate lending, here is your host for The Mortgage Voice, Jeff Barton.
Welcome, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, listening to us on a weekly basis as we try to figure out what's happening in the world of mortgages and real estate. Thank you very much again for tuning in. We're with you every Saturday and Sunday. We come to you through KCAA, their broadcasting tower, both AM and FM signals, and in the Inland Empire at San Bernardino and Riverside counties, and all the people out there who can hear this as far away as Palm Springs, certainly some parts of LA County and Orange County and a little Indio. Yes, we're up to 15 too. Hi, how are you? What's happening out there? How's real estate for you? Are you feeling it? Are you feeling like maybe this spring will be the time that you can get out there and buy that house that you've been looking for? I know you've been looking, and I know that the prices haven't been friendly. Well, I don't have great news for you, but I do have up-to-date news, so let's get right to it. Some of the housing news that we have is that prices have waned somewhat, have come down a little bit. And then, of course, as soon as the interest rates went back up on mortgages, we saw the price go back up again. So we're in a quandary as to where exactly this market will settle, whether it is in the spring buying season, in the summer, gotta find that house before the kids go back to school season, or whether it's going to be in the fall or even towards the end of the year. Fed has yet decided to figure out what they're going to do, whether they're going to raise or lower their Fed interest rate, and of course, tangentially, that affects the mortgage interest rates as well. I'm Jeff Barton again. Thanks for tuning in. Interest rates, let's get right to it. 30-year fixed rate loan is 7.10%. So it's above 7% again, not great. And we were so looking forward to maybe in the low sixes, high fives. Let's say 3-4 months ago, if you had said we would be at 7.10 today, I would have laughed because we had seen a great come down in prices for mortgages. And especially through the holiday season, we saw 6.5% 30-year fixed. Now, of course, we're up over 7%, not a good sign, not a good sign of things to come. And I think it's all has to do with this mishmash of where is the economy, where is inflation, and we'll get to some of that a little later on in the show. 6.57 is the 15-year fixed. Not bad, but not great either. 6.65 is FHA, 7.40 is the jumbo loan. The 5-1 ARM is pending right now. I don't have those statistics right in front of me on my screen, but we'll get to them hopefully by the end of the show. The 2 years at 4.681, and the 10 years at 4.252. So the spread in the 10 and the 2, the difference between the two, has widened. Was down about 30 basis points. Now we're up over 40 basis points. These are also not good signs. Now, we have the naysayers and the optimistic people who really conflict one another all the time. Now, if you go to the sites that I go to, which is Housing Wire, the MSN, their financial page, you go to Yahoo, their financial page, you go to Bloomberg, that's another good source for financial information. All of these sites have articles, and if you drift down 1, 2, even 3 weeks and look through the chain or just look at the headlines, you'll be amazed. Well, maybe you won't be amazed, but I was amazed at the difference on the same website from different people chiming in as to what the economy is doing and certainly what the housing market is doing. And of course, the housing market is directly affected by what the mortgage rate costs. If the mortgage rate is over 7%, you can bet you're going to see an increase in inventory, and that's what's happened. You do see an increase in inventory, both here in the Inland Empire, certainly in the counties to the west, going towards the ocean, and the rest of California, most of the nation experiencing the same thing. 7% mortgage interest rate puts people out of the ability to be able to go out there and get a mortgage. It just does. It makes the payment that much more. It makes reserves that much more, down payment that much more. It is not a good sign. Now, one of the things that I have seen is some of the older people who own homes are starting to sell a little bit more. This is why we see more inventory than we quite normally would in this time of the year. They're trying to cash in, figure out what's the best time to be able to sell your home so that you can take advantage of the equity that's been building up there for any number of years, 3 to 5 years, certainly ever since COVID. And by the way, Daryl, COVID was how long ago?
It's been like 4 or 5 years at this point.
It's exactly right. It was, I believe, this time in 2020. We're 2024, so 4 years. We're going to be at another election. And it's going to be almost 5 years since the start of COVID. Now, why do I bring that up? Because a lot of what our particular focus is on today is inflation, the inflation problem, what's happening with inflation, how does it affect our buying, how does it affect our selling, what does the Fed know that we don't know, and why aren't they lowering interest rates so at the same time we see mortgage interest rates lower. These are the important things that we're talking about when we talk about inflation and we talk about the beginning of COVID. At the beginning of COVID, I digress. Yesterday, and why I bring all this up, surfing around on social media, like everybody does, right? Trying to see what's out there without revealing who the heck I am, kind of hiding, creeping, that kind of stuff. Until you see something that motivates you, no, you got to jump in. So this is what happened to me. I'm looking at a post. I forget what social media, what's the difference? Aren't they all the same now? There used to be a standard difference between LinkedIn, between Facebook, between Instagram, Snapchat, Twitter. Now, anywhere you go, you see the same drool of complaining or, hey, I have a question. When the economy was like this, do you think it was better or worse? If I get asked another question by somebody, it's exploding. Anyway, so yesterday I come upon a post. The post did exactly that. It asked me a question about the economy. It asked me a question about inflation. It said, in March 2020, now this is March 2020? Yes. March 2020 or November 2000. I think it was March 2020, right? Right before the pandemic started to take hold of the economy. It was certainly at that time during that 2-week period where the country was shut down. The president came on, got to shut down the economy, backed up by all his medical people. Fauci was there, and so this is the date. And the question was, gas was at $2.29. Well, it never was that in California, but for the rest of the country, yeah, it was. And food costs were, I forget what it was, but it was cheap, right? Do you think you're better off today than you were then? Well, this is, as I said, one of those things that just goes, come on. So I began to lay out, and of course, I get wordy when I start to explain things. It's one of the problems of being a business owner for many years is that you have to explain things to people in such a way that they understand it. So the historical perspective on a simple question like that is, what's happened over the last 25 years? Okay, so I start going through it, I said, hey, we've had a debt problem. We've had a building, $1 trillion debt problem for the last 20 years. And it is snowballed during COVID. And one of the reasons that prices were what they were and why inflation took hold for the way it did was because people needed to be, either housed or needed money to live or because the economy was shut down. No perspective in the question. It's just meant as a political driver to make you feel a certain way so that you hate one group or like another group. That's all it was. So this is what I started to think about and going, okay, so what is the scenario that we're finding ourselves in today, and why do we have such a limited access to the information that is right there in front of us, but it's not right there in front of us? Because, as I said, every social media that you go on is exactly the same thing. We got another stupid election coming up. We got lines drawn in the sand. We got impeachment court things with one guy. We got impeachment hearings with another guy. It's just a morass of nonsense. So let's try to figure some of this out. Prices have risen in the real estate world over the past 3 to 5 years. So much so that the actual, what is that? Oh, gas prices?
No, the time.
Oh, the time. Oh, okay. Oh, very good. Oh, it's 2:29. Okay. Well, we've got to sign off here because I have a 2:30, and I appreciate you listening. We'll get back to my lecture in just a few moments. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us each and every week as we bring to you information about housing, information about mortgages. There's so much going on most of the time, although the news this week, last week, and the week before is not the greatest because interest rates have risen. But the converse to that is we see more houses on the market. So it's a push-pull. I always say get into the market. You can always refi. I know for some people that sounds callous and cold, but it is the actual truth. Certainly if you're in a market that is something you want to buy and you can afford it right now, the payments, we do see at some point this year rates will go back down, and that'll be an excellent time to refi that house. Anyway, I'm not the expert on any of this. I wish I was, but I'm not. The guy that I'm bringing on the show right now is Jamal. Ransford. He's been on the show many times. He's with EPM, and he joins us now. Jamal, how you doing?
I'm doing excellent. How are you?
I'm okay. As we were talking off air, I'm doing a little bit more of my moonlighting job than I am at either the radio job or mortgage business, but I like it. Life's okay, and I guess that's the most important part of it. We got rained on. How's that affecting business?
Business is great. As you said, the market changes. Today is good, tomorrow is bad, but
Right.
if you could buy real estate, it's always good to buy.
I agree, 100%. The products that you're offering, products that you're in love with over at EPM, is it standard fare, or do you have something new and exciting, or something you want to?
Absolutely, Jeff.
Great.
Didn't mean to cut you off. We got some great stuff right now.
Great.
We have our down payment assistance program where we just now took it to 580 credit score.
Wow.
All you need is a 580 credit score, and EPM will give you a grant. And the grant is totally forgiven the day you sign that dotted line. You
Wow.
don't have to pay it back. So if you are someone that, life happens to you, you want to buy a house, you make enough money, but you just can't save to put down payment, don't worry about it. Give us a call. We'll help you get a house. We'll give you the down payment to buy that house. All you need is a 580 credit score.
That's insane. That's
Absolutely
It's not
insane.
insane. Let me put it like this. That is a great loan for somebody who's had some issues credit-wise. There's a number of reasons why anybody could have credit issues, whether it's medical, whether it's just a one-time bankruptcy, divorce, all kinds of reasons why people might have a 580 credit score. Tell me about it. Is it an FHA program? What is it?
This is actually only FHA product, but
Okay.
we it's an absolutely beautiful loan. I mean, I'll be honest with you. A lot of people using this because, yes, there are houses on the market, and it's time for us to, build the economy back up. But it's important to notice, if you want a house, there's a way, and we'll make that way for you. If you want a house right now, you're trying to invest, you're trying to buy a house, you're trying to move a family, you're trying to do anything real estate-wise, there's a way to make it happen. And for us, EPM, we've got this great product. Like I said, it's for doctors, nurses. There's no income limit. So we are giving you a free down payment to buy a house, even if you make $300,000, $400,000 or $30,000 a month.
Tell me, okay, so normally FHA is at 3.5%, right? That's what they're asking you to
That is
bring
correct.
down. So
Exactly.
you're saying that the grant is for 3.5% of whatever the purchase price is?
That is correct.
Okay. And in doing that, the qualifications, you said there's no income qualification. Is there any other qualification? Obviously, ability to repay has to be one of them.
Absolutely. The
Right.
ability to repay will be there. Of course, you got to be able to buy the house you can afford the house you want.
Right.
Yes. So as long as you can afford the house, EPM, myself, will grant you the money, and it's free at close. You don't have to pay back. And then if you decide you want to sell it 3 months from now, 6 months from now, there's no repayment. You don't have to pay us back a cent.
Okay, so that 3.5%. Now, is this part of a government-sponsored program, or is this?
This is actually EPM sponsored program.
Wow.
Yes.
Wow, that's amazing. And there's no cap on that 3.5%?
There's absolutely no cap. You could actually use your own money if you have it. You could use a gift. But yes, we will give you the 3.5%, and then the closing costs if you have money, or if you have a relative that can give to you, or if you have the seller credit to go towards their closing costs. But you could literally walk, and no underwriting fee. EPM will not charge you an underwriting fee for helping you get this house. So we give you the 3.5 plus no underwriting fee, and you could literally walk into a house that you could afford with just appraisal fee of $500 or $600, depending on the area that you in and how much the appraisal costs.
Well, this is an amazing program. Now, I've heard of DPA programs for years, and I've, even the ones that get forgiven after a certain amount of time, but they're always tied up with a county, a city, a state. This is all private company money, and you're doing it because not only do you get the insurance, the PMI, which protects the bulk of the loan, but this 3.5% is that's a big chunk of change. Usually that's how much, you're making on a loan is, less than that, actually.
Absolutely.
Well, this is pretty good. And how long have you been doing this?
We've been doing it for the last 5 years, actually.
Wow. How come I don't know about this program? And how come
now
everybody...
If you bring me on, I got more products for you.
Okay.
I absolutely have multiple products for you. So just bring me on. We have more to talk about. But yes, this DPA is the best DPA on the planet right now. Free money. You want to buy a house, call us. Let's get you some free money.
Okay, let's talk a little bit about what's happening in the economy and how that is affecting the ability to repay. I know that some companies out there have been laying off, even though the unemployment figures really don't reflect that. But you read about it every day. A lot of tech companies, especially a lot of real estate companies are laying people off just because there isn't enough business. Protecting, obviously, the ability to repay. How are you dealing with that, and what do you see is happening out there, especially here in Southern California?
Well, the thing is, everything that we're going through has been done before. Mm-hmm. So you just got to pivot, make changes, and then come back stronger. So, yes, sometimes you have to lay some people off to get things correct and bring them back. We as a company, sometimes we'll let some people go, and then when the market get back up again, we'll bring them back on board. But it's just the way the market works, right? It's not companies. We all trying to feed our family. We all trying to take care of everybody. And sometimes you just got to do the hard cuts. So,
right.
The market is still picking up. The rates has gone up. I agree 100%. But the rates will come back down. That's why it's important to buy now, because in the next 6 months, I've got my Tom Ford glasses on. I could tell you, in the next 6 months, the rates will go back down. And when it does, you can refi, take some cash out, and do some stuff. So don't worry about the rate. As I always say, marry the house, date the rate. Uh-huh. You could break up with the rate anytime you choose, but the house is something that you want. So please, do not let the market scare you. Business is still thriving in some areas, and even in California, it's doing absolutely great. I'm actually in the Dallas area, and I can tell you Dallas is thriving.
Well, Texas is stealing everybody from Southern California. That's what's going on.
Absolutely. We've got some great stuff in Texas. So,
right.
Hey, if you want to move to Texas, I'm here as well.
Excellent. You got room at your house? I could come down tonight.
Yes, we've got plenty of room for everybody.
Oh, excellent. Okay, so, all right. So now you've been at EPM a long time. EPM is a company that's been around a while. And this particular product, give us an example of another product as well as this DPA program that you might think is something people hadn't heard of.
Yeah, we've got some great products, too. We got that FHA 2 or 3K, which also helps you if you have equity in your property right now, and if you want to rehab, you want to do some renovations, we'll help you take some money out and renovate the house the way you want. So we've got multiple programs that you could actually use. Also, our veterans. If you're a veteran and you want to, buy a home, we can help you with that. Or if you want to also do a renovation as a veteran, we can help you as well. So we have multiple products for everyone.
Okay, Jamal, we are in the last minute of the interview. Could you let people know how to get in touch with you, either by email or by phone or however you want to do it, so that they can talk to you? Great. Go ahead. Shoot.
Absolutely. If you want to contact me, you can contact me directly on my cell phone, 214-929-8234, or you can email me at Ransford, JRANSFORD, @EPM.net. If you have any questions, email me. You want to talk, you want to know about our products, you want to know more about what we do, how we can help you, please reach out to me.
Jamal, thanks a lot. I appreciate it. I missed talking to you, and I'll be around for at least another year because I just re-upped.
I tell you what, we're going to start doing this once a month now.
Excellent, Jamal. I appreciate that very, very much. Thanks very much for coming on the show.
Thank you so much, Jeff.
You're welcome,
Always
man.
a pleasure.
Thank you. Jamal Ransford from EPM. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us on a weekly basis as we bring to you the best news out there in the marketplace that talks solely about real estate and mortgages. Yes, you can't do one without the other, and the most pressing need right now is lower interest rates, but that's not happening. But we do have loan products by the people that come on the show to help you out, to get you into a house so that in 6 months, a year, you can refinance it into something lower. That's kind of the strategy of a lot of companies that are talking to you about it now, but it's difficult when you have one-on-one. On this show, we bring to you lots of different people to talk about not only the loans, the interest rates, but the different products and the way by which you can get approved to get your loan done so that you can move into that house. Good thing about high interest rates is inventory builds, and when inventory builds, prices fall. So even though you may see, hey, you know what, this mortgage interest rate has gone up over 7 again, house prices have fallen a little bit, and they've fallen just because there's more of them on the market. Now, it is market sensitive, of course, but we're here in Southern California, San Bernardino, Riverside counties, KCAA, my friends over there, Fred, Mark, everybody else that brings us to you, thanks very much. However, on the show right now, joining us once again is our resident expert in the field of all kinds of different loans and loan products, Charles Giscombe. He's from United Security Financial, and he joins us now. Charles, how are you?
Jeff, I'm great. Thanks for having me today.
Thank you very much for coming on. That was a world-class introduction, by the way. I just got to tell you, both vocally and content-wise, I nailed it. I just had to give myself a pat on the back there.
Attaboy.
An attaboy. Okay. So in our industry, there are no attaboys, right? Client comes to you, wants a particular loan, interest rate goes up, you come back to them and you say, this is not going to work at what we talked about. They get mad at you. What's the best thing you can do for people in a market like this where we see it's just kind of floating around, but generally over the last 6 weeks been going higher?
You know what, Jeff? That's a great question, and it happens especially in this market. For the last year and a half now, Jeff, that's the way it's been. So what I always do is say, hey, listen, I'm quoting you something today, but you understand the interest rates are on the rise and different things happen.
Right.
Hopefully, we can stay right here, and we put ourselves in float rate locks. And what that is, the rates go up, the rates go down. We'll time it and take a look at the trend and try to lock that loan or that interest rate when we feel like it's best low. We can't promise anything, but we try to do that. That way we can, give the client the best interest rate. But things change all the time.
Yep.
And when the rates are changing, the lenders change as well to hedge their bet. They don't want to be in a loss situation either.
Right.
So there'll be an LTV that you had. It might not be there next week. They may put out a rate sheet that says, hey, we don't have that anymore because the market's fluctuating and that volatility is causing us, to circle the wagons and protect ourselves. The only thing that you can do is always talk to your clients forthright. Be completely transparent and let them know in this market, things are changing every day. So we're going to give the best possible situation and scenario to you that we can give you today. If it changes for tomorrow, we feel like it's going to get worse, then we'll lock ourselves in. But at least you're giving them exactly the truth and being transparent. And also, I always tell them, this is just a short-term strategy. We're not thinking long-term. So don't think that you're ever going to be locked into this highest rate and these terms not as favorable. We will always put us in situations where we can refinance. We don't have any prepayment penalties or limited to, which will allow us to refinance and change our terms for the better and the rate for the better when it's an opportunity to do so.
Okay, let's talk a little bit about, you talk about this lock-in thing, and a lot of people don't really understand what that is and how it works.
Right.
I think in general, they have a rate that you say, okay, I want that rate, and then you have a lock. They used to charge these lock-in fees, right? They used to charge you to be able to do that. Now, clients say, well, wait a second. If I lock this rate and a lower rate comes along, how come I can't just relock the lower rate?
Well, what happens in that situation is you do have the ability to relock the loan. Now, that may cost, but
Right.
by law, it can't go up. We can go down. You just can't put a person if you lock it in a higher interest.
Right, right.
So that's favorable to the client, and you always have to let them know that ahead of time. Like, listen, by law, if there's a better rate, we can relock. It may come at a cost or, but at the end of the day, we do have the ability to lower. We just cannot go higher than where we are. And I always let our clients know, you're in 2 years ago, year and a half ago, you're in 3s and 4s. You're locked. You're good. No problem. There's no worry. Let's just get it done because, that's a great rate.
Right.
But you get in the 7s and you get in the 8s and you're pushing it up to 9. We're just trying to take a gamble, like we're in Las Vegas, to say, hey, let's not do it right now. The rates might get a little better, and then we lock them. We're looking every day like, and then you see that email come across your screen. The prices have worsened. Oh, goodness. And then you got to go, well, we're not going to lock now. Let's wait until tomorrow and see if they come back down or the next day. So locking in is just saying, if you feel like the trend is going to go up, we should lock right now so it doesn't get worse.
Now, there was a guy out of Florida a few years ago. I forget what the guy's name was. But he used to post every day what you should be doing. You should be floating. You should be locking. You should be waiting. You should be doing it now. And that is it sounds like it's a game, right? It sounds like, wait a second here. This is like you said, this is like Vegas. You're trying to bet which way the wind is blowing. As a loan officer, because you don't control any of this, you're just trying to deliver the news, good or bad, whatever it is. How do you explain to the client that, hey, you know what? I'm only, the deliverer of the message. I don't make rates. I don't, have the money to be able to move markets. This is the way it is because that's what the lender said it is. And then they go, okay, why are we at this bank? And so satisfying the customer's need for information is an ongoing process that I guess you have to just stay on top of when things change.
It's just like you said. That's how I explain to all my clients. I am not responsible for the interest rate. I'm not responsible for LIBOR. I'm not responsible for anything. The only thing that I can give you is to the minute or second information that we gather as loan officers and loan originators. Give it to you so that we can make a determination together. It is like playing the market.
Right.
Every day as you're watching, you're not sure what's going to happen. Something may come up. A war may come up.
Right.
Something may happen. A disaster happens. Markets get upset, and they get worried, and the things change. Now the rates change. So I always am just explaining to the client exactly how it works in layman terms. And at the same time, I always tell them as well, it's very rare that you get the best rate and the best terms. Most times it's one or the other. So if we're going to have high interest rates, let me get you in the best term loan with the best terms for you, structured for you, because that way we're not so concerned with interest rate. We always talk about it, when Jeff always talks about it with loan officers, is the real top of the food chain and the real cream of the crop are not the individuals that are selling when the rates are really low. It's the individuals who can still get business done when the rates are high because they can explain to the clientele exactly what's happening in real time and make them comfortable in the position and situation we currently are and getting the best terms possible that can at least have their payment, their monthly check writing as low as possible.
No, that's great information. And you bring up a point, of course. Are we in the type of market now where you see interest rates the way they are, and maybe they go up even further, but the actual ability to get the loan done is made easier, less documentation, or are both more difficult? What market are we in?
We're in a market where the interest, usually when a person gets in a traditional mortgage, now when I mean traditional, I mean a government loan, FHA, VA, right?
Right.
Or traditional conventional loan, Fannie, Freddie. When you get in those loans that require the bank statements, the tax returns, the W-2s, the paycheck stubs, the full doc loans is what we call it.
Okay.
You usually get into those loans because those loans that you provide the most information for are the loans that have the lowest interest rates. But when the market has high interest rates across the board,
Right.
it doesn't mean that those type of loans are now going to be more favorable. I always tell my clients, you always have the ability to do a traditional loan, but you have to have all that documentation, and you have to be able to provide in black and white the documents that say you have this ability to repay. But in this market, Jeff, I feel like for most clients, I would take the other route, and that's a non-QM loan, a non-qualified mortgage that doesn't abide by the same requirements and guidelines that a traditional mortgage does. Now you can be creative, provide bank statements to do a profit and loss. There's some no-doc loans. Of course, the interest rate is higher, but you get in the loan easier. The interest rates are already high. There are other value-added services that you can add to this loan that will allow you to pay a lower payment, like a 40-year loan or interest-only option with no prepayment penalty, or a loan at 90% with no mortgage insurance. Those things make it very competitive for that particular non-QM loan versus a traditional loan with less documentation. So in this market, I always tell people, you have an opportunity to get into a loan that is more favorable to you in terms and requirements and guidelines, and even still provide you an opportunity that when the rates do get better, you can refinance into that traditional loan when you get the really low rates where it makes sense. So I always would suggest do a non-QM loan to get the leverage to get in for the acquisition.
Right.
And when the rates get better, let's go back to the traditional loan to get that low interest rate loan that you then can lock into for 30 years and not have to worry about it anymore.
Yeah, I like the strategy. I like the way you explain it. Obviously, less documentation for a lot of borrowers is the better way to go, especially with, I hadn't heard CPA letter being used as much as it has been bandied about in the last 6 months. So if that is now a viable way by which you can prove business income or personal income through a letter from your CPA, well, that just gives you much more flexibility in terms of how to get that loan.
Absolutely, Jeff. I always try to explain to people in layman's terms, when you use your tax returns and your W-2s, that's public information. The bank can go look at that and pull your 4506T and know exactly who you are, how much money you make,
Right.
your habits, everything else. Okay? So that's an easy loan for them to look at. So they don't have to look at so much. Now you have to provide a lot more documentation. But one thing you have to understand, compared to a traditional loan, a non-QM loan, they're using your CPA. They're using your bank statements.
Right.
They're learning who you are in that loan because you don't have the 4506T to lean on, which is the tax returns. So now they need to learn who you are, learn your habit, and show how much money you make in a month in bank statements, and you justify that by taking the average of the bank statements. The CPA letter confirms the information that's provided in the bank statements and lets them know that you've been existing for a certain period of time, that you have this much ownership, and that you're a viable individual for a loan, and that you do have the ability to repay. It's a great alternative to providing all your tax returns, especially if you're an individual who writes all your taxes, write everything off in your tax returns. I think it's a great way to get into a loan without having to provide all the tax returns and information you would normally have to provide in a traditional mortgage.
Excellent explanation, especially on that CPA letter. We've run out of time, unfortunately, but we always have you on, so we'll have you back soon. Could you let people know how they can get in touch with you, especially with all this information that you've been giving today?
Sure.
Thanks.
You can reach me at that good old Las Vegas, Nevada, 702-328-5191. That's 702-328-5191. or you can reach me at cgiscombe@usfwholesale.net. That's cgiscombe@UncleSamFrankWholesale.net.
Excellent. Very nice. Sounds ham radio-esque. Very nice. Charles, thanks for coming on the show as always.
Jeff, thanks for having me. I love being here. Thank you.
Okay, excellent. That's Charles Giscombe from United Security Financial. I'm Jeff Barton, your voice in the mortgage industry. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For questions or comments, send emails to info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to what we have to say about what your world is going to be like, especially if you're talking mortgages and real estate. The rest of it, I don't know. We do generally hit most of the economic points nationally. We try to bring to the show guests that can talk about the macro and the products that you will be able to use so that you can take advantage of whatever real estate that you're looking either to buy, rent, purchase, whatever it is. Rents have been going up in the real estate world, not a great thing. Commercial real estate is in the dumps, and there's real fear among a lot of building owners across the country, if not even in smaller cities, that they're just going to have vacancy rates that are going to drive the price of the buildings down. There are some, as I saw yesterday on Bloomberg, or it was CNBC, I forget, one of the two, that we've seen a lot of movement in terms of real estate in the commercial sector for the first time in about 6 or 7 months, but to the lower side, i.e. they have to sell low because the buildings aren't worth what they were, because nobody's renting them out. So what are you going to do with these buildings? 25% of the buildings out there have been primed for renovation to residential real estate, and I saw that and heard that again on one of these channels that I watch all the time. This is the thing when you get older. You can categorize and remember, but if you don't write it down, you can't get specific, especially because I talk fast. So if I can't come up with it instantly, I just move on to the next thing, and nobody seems to notice. No one ever calls me on it, so I guess it's okay. All right, so let's get to a few facts about what is happening in the real estate world as well as the economy generally, and then I've got a little bit of a talk to do about what's happening in the real estate world and what's happening to these lawsuits that keep coming up. But prior to that, Rocket, Red Ink, 2023. Okay, Rocket Mortgage, Rocket and United Wholesale, two of the biggest mortgage providers in the country, behemoths really. But we see, and Rocket is one of these companies that have laid off some people. UWM too. But there's a lot of red ink in 2023. Not a good sign. But as everyone knows, the reason why is because the interest rates are too high. And everybody that's in at 3%, they're not selling anytime soon unless you're the few and far between people who are, like me, older, who want to get some money, retire somewhere else, and pass some money on or spend it. RE/MAX changes leaders. Bailey out, Lenzinger in. Okay, so RE/MAX, along with a lot of other people, got whacked with that huge lawsuit that I want to talk about a little bit later in the show, the lawsuit about commissions and how NAR and these bad real estate companies have been conspiring to keep the commission rate at a certain amount. That is still in the courts, even though there is a huge $1.6 or $1.9 billion settlement. It's state by state. There's several here in Southern California being litigated right now. It'll be interesting. The one case that really set the precedent for this is called Sitzer or Seitzer. Anyway, very interesting. Keep informed. When you are selling your house or when you are buying, make sure that you get a very thorough explanation as to what the costs are to use the services of that particular realtor. Okay, just a word to the wise. EXP reports loss in the fourth quarter. Okay, agent count slows. So much of what the companies, whether it's a loan officer company, a brokerage company, whether it's a bank, whether it's a real estate firm, real estate company, relies on the sales force. The sales force is the company most of the time. If you find products selling, you wouldn't need salespeople to walk people through it. You wouldn't need licensures. People would just go online and do it themselves. But it's hard, it's complex, it's not easy, and you need patience. And you need full-time focus on that particular subject so that you can provide the best possible answers to the questions you're going to have, like, what is this rate? What do these documents mean? I don't understand the contract of real estate. All of that requires professionalism. And as I said, the sales force that these companies have are their greatest asset, which is why when I'm talking about EXP reports loss in the fourth quarter and their agent count slows, that's not a good sign. Now, in regards to that, again, I'll talk about that in a second, about how companies in the real estate business, and there are a couple of articles out there that you can read. You can go to MSN, or you can go to Yahoo, or you could go to Housing Wire or Mortgage News Daily, any of these sites, and you can read about it as it happens. Okay, inflation up, rates down. That's true. Rates up, applications down. All right, so the applications for mortgages are down this month, and the reason they're down, obviously, we've been talking about it all show. Interest rates are up. Price gains are slowing. Yes, they are, and that's obviously because the demand is slowing. Because why? Everybody together? Right, the rates are too high. That's why. And when the rates come back down, you'll see demand go up, and you'll also see the price of homes go up. Now, the one thing that can mitigate all of that is if someone gets going and builds some more houses. But as I said, that is that's a slow go in most areas. I mean, most built-out areas here in Southern California, certainly in San Bernardino and Riverside, if you're living in a popular area, they're not going to open large-scale development. You got to go up to 15, up to Hemet, Menifee, all these other places in order to get a new house. Now, there are some great houses up there, but it is further down the road. And if you've got to commute to some place closer to Los Angeles or anywhere in the Tri-County area, and you got to go that far away, it just adds another hour and a half to your drive time, especially during the mornings and evening commutes. Nobody wants to do that. So, as I said, yeah, it's nobody wants these large developments in their backyard. It's a slow go. It's infill. Other than that, you got to drive way out. Inventory up 15.7% year over year. That's what I was talking about, the inventory being up. And new listings are up 10.9% year over year. So there is some hope out there. You can get to it. All right. The broker strategies that I talk about now are for people in the business, right? These are strategies by which you can use in order to stay in the business, in order to grow your business. Okay, let's just go through them quickly. There's just a few of them. Determine whether you be a competing or a non-competing broker. What does that mean? I was a non-competing broker, meaning I did not do deals when I was a broker. I really focused on service to the loan officers, service to the real estate agents. That's something you have to determine for yourself, which is the best way to do. There are a lot of originators out there who own their own mortgage companies. So they really have most of their bills paid for by the commissions they get from other loan officers, and they keep 100% commission for themselves, a little skim from the top of the other loan officers. Develop profitable commission structure, obviously, right? So most commission structures out there are 80%, 80-20, right? Loan officer or the real estate agent gets 80%, company gets 20%. Now, there are some other kinds of commission structures, but for the most part, if you've got that, you're probably going to do okay. Volume or premium listing. So this is another way by which you can build your business. Either you're going to do a ton of transactions, which means you're going to come in at the lowest cost. That's how you do it. Or you're going to say, no, I'm going to charge 7%, and I'm only going to do, these really high-end properties. You can do that too. Or you can do a mixture of both. These are strategies for your brokerage, for your business to be able to make money and obviously stay in business. Optimize your management. What does that really mean? It means focus on what you do best, focus on what the company does best, focus on making money for your loan officers or your real estate agents. Diversify stream of income, okay? Just the opposite of that. I don't like diversify stream of income. Why? Because you split focus from what you really need to do. This is a service business. Always is, always will be. Customers need your attention. And if you're the broker and you have loan officers out there, they need your attention because every deal is a potential nightmare unless they've got backup and support. So diversifying your particular income stream may confuse you and your people as to what your real job is, okay? And then draw upon your expertise of others. Well, that's obvious, right? If you have somebody in your office who does something way better than you do, you need to get them in line with that, whether they're commercial people, whether they're land development people, whether they're single-family residence, condos. There's so many different ways by which the real estate industry can grow. Now, I talked about Seitzer, the lawsuit NAR and real estate companies had, and that they lost in Missouri. I think it was $1.6 billion that they have to pay. Now, these lawsuits are coming state by state. So the issue here is the loss of $100 billion in real estate commissions each year is projected if these lawsuits continue. 30% reduction in overall commissions on a yearly basis. 1.4 million realtors out of work. This is such a crucial area that a lot of people say, so what, they go out of business, what do I care? Well, you will care if you get hosed in your next real estate contract, especially if you're being dual represented by somebody who really shouldn't be dual representing anybody. The process by which to pay your realtor, to pay your loan officer, is going to be changing in the next 2-3 years. Just is. And whether the NAR wins this lawsuit, they're going to be tied up in court for a long time. So the proactive way to approach this, whether you're a business owner or you're a client, is to look at services being rendered and come up with a reasonable cost or a reasonable price you would pay for that. And begin your search by finding someone who understands the changing marketplace and can be able to be there for you and charge less. I mean, that's really what it's all about, right? Anyway, I'm Jeff Barton. Thanks for listening to the show. We'll be right back.
You're listening to The Mortgage Voice with Jeff Barton. We'll be right back with more in just a moment. For more information on today's topic, email Jeff Barton at info@malibufunding.net. Now, back to The Mortgage Voice with your host, Jeff Barton.
Welcome back, everybody. I'm Jeff Barton, your voice in the mortgage industry. Thanks very much for tuning into the show, for listening to us as we bring to you the best news out there in the mortgage industry. There isn't another show like this on KCAA, I can tell you that right now. Anyway, thanks again for tuning in, listening to what we have to say. Inland Empire, the San Bernardino and Riverside County area, certainly out to Palm Springs, little part of L.A., Orange County, and certainly up to 15. We are there for you. We're on Saturday and Sundays on KCAA AM FM signals, and both of those places where you can hear us are readily available. I know KCAA has been around a long time. Fred does a great job out there, and I really appreciate what he does. If you want to see the show, and you can do that, you can go to YouTube. Jeff Barton, The Mortgage Voice, is our YouTube home. And we've been doing shows there. Oh, my gosh, we have hundreds of them. How many shows do we have on there, Daryl? Do you know?
350-ish.
Okay, yeah. That's a lot of shows. As I said last week or the week before, I forget which, people binge watch this mortgage show on YouTube. Yes, I know it sounds ridiculous to some who say, how can you watch a show from 3-4 months ago, let alone 3 years ago, and be up to date? Well, I think they do it because there is a through line to a lot of these shows and what we do.
And you can tell whether you're right or not.
Yeah, well, that's true. Nobody's, you know, I tell you what, I'm not a great guesser. I can only follow what the markets do, and through my own experience of being in the mortgage and real estate business for about 25, 30 years, I do have a perspective, but certainly it's jaded, right? I mean, I'm looking at it from a professional standpoint, looking at a way by which, how does the market move, what moves markets, how is the government getting in the way of things, where is the greed in the business, and why do people do what they do? This is really what agents and mortgage professionals look at when they're looking to try to, you know, size up whether they can do a deal or not, whether they can get a loan done, whether they can sell a piece of property. It's a business, so they need to make money. But as is my current state of affairs, which I'm no longer in the mortgage business, I do some real estate on the side, especially in Las Vegas and here in California. But it's a little bit different in that the information that we give to you is information that you can probably take and use. Anyway, binging the show 3, 4, 5 months in a row and seeing, I don't know, 15, 20 different episodes, it's hilarious to me because other than finding out whether I'm right or wrong, getting a feel for what the market is, seeing how it goes up and down, maybe just like the voice, I don't know. Now, one of the things that is unusual is that we have a certain demographic that seems to like the show versus another demographic. Now, I don't know why that is, and I don't really have that much input, but I'm always skeptical as to why things happen the way they did. We talked a little bit earlier in the show about social media and how my belief it is all very much the same. There is no difference, and all of it devolves into, do I really want to spend time learning about, I don't know, whether a question about a certain politician is right or wrong, or whether I want to watch another cat video, or whether I want to, whatever it is that you want to do, that you consistently do. And by the way, all of these AI-driven social media sites will give you what you're looking at. So if you're looking at something, you're going to find a lot more of it the next time you start searching or looking randomly, which is what most people do, whether it's TikTok or Instagram, Facebook, I don't care what it is. Now, in order to build an audience, what I've been trying to do for years, in order to get this show to more and more people, especially in the Inland Empire, where I think what we do for you is to describe exactly what's happening in the real estate and in the mortgage markets. One feeds off the other. Obviously, if you have low real estate prices and low mortgage rates, you're going to sell a lot of property. There's going to be fewer inventory, which will drive up the market. If we do finally get that recession, now I don't know whether it's ever going to come. They said no, they said yes, they said yes, they said no. Right now it's in the no column. We don't know. I mean, there are, as I said, if you go to any of these social media sites, you will see competing and opposing viewpoints as to what's happening in the real estate market, what's happening in the mortgage market, what will happen with the economy. And in regards to what's happening with the economy, let's just get to a few news-to-use items, which I think is pretty interesting. We do the gross domestic product GDP tracker, usually about once a month, once every couple of months. There are certainly many ways by which you can figure out what's going to happen in the past, but as what's going to happen in the future, how does that affect you? Well, obviously, we don't want to see the recession. Nobody wants to see that, because that means you get laid off, and that means a house that has just accrued in value over the last 3 to 5 years will probably sink in value, and your 7% mortgage looks worse and worse because the value of your home goes down and down. So nobody wants a recession. So let's look at the GDP tracker. Bank of America says 1% in Q1. That's what the gross domestic product will go up. Now, Bank of America, Brian Moynihan over there, and the people, they're always conservative. I don't know why, but 1%? We just came from a quarter of 2.9%. Anyway, it doesn't make sense to me unless there's something that I'm not aware of. I look at oil. Oil is at $73, so that's cheap. I look at gold. The gold prices are up, and that's a hedge against inflation. Everybody knows that. Just around $2,000. You look at gasoline prices. Well, here in Southern California, it's really odd and hard to really gauge gas prices because, as I said last week or the week before on the show, I was in Missouri, St. Louis, $2.50 a gallon. Yes, we'd kill for $2.50 a gallon. However, here in California, now, if you're going unleaded, $5, $5.50 a gallon. That's what it is, depending on the station you go to. Anything higher is obviously higher in cost. So gasoline prices here are pretty much what they were in, I don't know, holidays, a little after the holidays in January. And will they go up? Of course they'll go up. We'll be back to the summer blend, driving season. Yes, so gas prices here in California are not an indication of the economy. However, for us locally, it hurts. That and food prices are killing us in terms of cost of living. However, the actual GDP numbers coming from Bank of America at 1% kind of reflect that. However, if you look at Goldman Sachs, they come out with a 2.4% increase in GDP for the first quarter of 2024. I think that's way more in line with where we're going to be. And I say that, of course, because I do a lot of reading, and I am a very well-read economic watcher. I know I'm being facetious, but looking and making sure that those kind of numbers are what they are, in line with what they were in the last month, maybe down by a quarter point, a half point. Well, that's in line with the 2.4% prediction from Goldman Sachs. And the Atlanta Fed, which is always the most optimistic, it's not Waller down there. I forget exactly who it is. Anyway, the Atlanta Fed says 2.9%, same as it was in the fourth quarter. So they are seeing GDP growth very much in line with what it was in Q4 of 2023. These economic signs of things to come are, of course, backed up by what we also see in the stock market. Now, we don't talk stock market because it really isn't that kind of show. But if we're talking general economics, the stock market is a forward-leaning kind of indicator. What that means is, if the stock market is going up, it means the people who are buying and selling these things every day think that the future looks good in terms of the economy. So if you're looking at the Atlanta Fed and what the stock market is doing, you can say, all right, the economy looks like it's doing all right. How's my industry doing? Well, depending on the industry you're in, certainly in the tech world, and I'm talking about all across the tech world except in the AI world. NVIDIA itself is on fire. But if you're talking, Facebook and Twitter or X or whatever you want to call that, or you're talking chip makers, yes, we are seeing the economy in those particular sectors laying off people. So depending on whether it's specific to your particular industry will really make a difference as to how you're viewing local economy. But I generally see the economy looking all right, pretty good. And I do anticipate during this year, now I have been wrong 3 years in a row, so let's try to make it 4, that we will see interest rates in this year come down. When will they come down? I think you're going to see that when we have a more definitive look at inflation. Now, the inflation front is another thing entirely. We had seen inflation really come down quite a bit from 9% to about 3%, right? 3.3%. So the consumer price index and the producer price index both went up about 0.1% last month. Not a great sign. Why? Because we were expecting to get closer and closer to that 2% rate so we could see the Fed cut their short-term interest rates. What does that usually mean for mortgage rates? It means tangentially mortgage interest rates will fall also, because usually the bond, the debt that is being sold at those particular levels when the Fed cuts their interest rate, that means the bonds being sold will also carry less of a yield, which means that the mortgage bond that they are packaging after we sell loans does not have to be at that same level. So they too will lower the interest rates in order to be able to compete and compete fairly. Lowering interest rates will spark a rebound in the real estate sector, and I think that's coming. I just am not sure quite when that's coming. But anyway, I'm Jeff Barton. I'm your voice in the mortgage industry. Thanks very much for listening to the show, and we'll see you next time.
You're listening to The Mortgage Voice with Jeff Barton. For more on today's topic, visit www.malibufunding.net.